This is TechCrunch.
Framer, a no-code website builder that claims over 500,000 monthly active users, has reached a $2 billion valuation after raising a $100 million Series D funding round led by existing investors Meritech and Atomico. This double unicorn milestone comes at a time of hype for website builders, including direct competitors like Figma, Squarespace, and Wix, as well as rising vibe coding platforms such as Cursor and Lovable. In 2023, Framer raised a $27 million Series C led by Meritech at an undisclosed valuation. With this funding, we're doubling down on enterprise growth and AI, so any company can confidently run their entire website on Framer, CEO and co-founder Koen Book said. Rather than static landing pages, Framer supports dynamic websites that teams can quickly update without requiring developer support. More recently, the company has added analytics and enterprise security features with the goal of helping companies run their entire .com, Book told TechCrunch. Founded in Amsterdam by Book and Jorn van Dijk, who had sold their design studio to Facebook in 2011, Framer describes itself as the website builder loved by designers, with the promise that websites created with its tools will stand out. The Dutch company has also been investing more heavily into its enterprise business. Since introducing business plans late last year, Framer reports that businesses have become the majority of its new customers. These include companies like Miro, Perplexity, and Scale AI, as well as 40% of Y Combinator's most recent batch. The growing B2B business is already making an impact on the company's bottom line. According to a spokesperson, the company reached $50 million in annual recurring revenue this year and aims to cross the $100 million threshold next year. We've been break-even for the past year, Boak told TechCrunch. More clean tech manufacturing investments were canceled in the U.S. in the second quarter than were announced, according to a new study from the Rhodium Group and MIT. Companies canceled $5 billion worth of projects, while only $4 billion in new investments was announced. Actual clean tech manufacturing investments, not just announcements, declined by 15% as well. The pullback comes in the wake of the GOP's reconciliation bill, which erased key portions of the Inflation Reduction Act, a piece of legislation that spurred a tidal wave of manufacturing investments in the United States. Last quarter's cancellations are second only to Q1 of this year, in which $7 billion worth of investments were canceled. The latest projects to get the axe were predominantly battery factories, the report said. The industry has encountered new headwinds as the One Big Beautiful Bill pulled key supports for many of the projects by softening rising demand for electric vehicles and eliminating production tax credits. Cancellations in the first quarter were largely centered around EV production, while battery manufacturing was responsible for the majority of those in the second quarter. Still, battery manufacturing remains a key driver of new investments, hitting $8 billion in the second quarter. The pullback mirrors a broader retrenchment in manufacturing investments across the American economy, according to data from the U.S. Bureau of Economic Analysis. Spending on new factory buildings was down about 0.25% in both Q1 and Q2, the first period of consecutive decline since 2020. Just 2 years ago, about a year after the passage of the Inflation Reduction Act, the story was very different. Investments in new manufacturing structures hit 2.22%, the biggest change in new investments since 1978. The news comes as the U.S. economy grew faster than anticipated in Q2, with gross domestic product rising 3.3%, up from the 3% that the Bureau of Economic Analysis initially reported. Still, if manufacturing investment continues to decline, the economy's long-term strength might be hollower than it seems. That's all for now. For more stories like this one, visit TechCrunch.com.